Long-term U.S. Treasuries are volatile on their own. Now imagine tripling that volatility. Today, we're breaking down the Direxion Daily, 20-plus year Treasury Bull, 3x Shares ETF, ticker TMF, and explaining exactly what it is, how it works, and why this ETF is strictly a short-term tactical tool. This is the ETF Investor, and TMF is not for casual investors. TMF is a 3x leveraged ETF designed to deliver 3 times the daily performance of an index of U.S. Treasury bonds with more than 20 years to maturity. Specifically, it tracks the ICE U.S. Treasury 20-plus year bond index on a daily basis. The key word here is daily. TMF resets its leverage every single day. That means it's engineered to amplify one-day price movements, not long-term trends. Over periods longer than a day, returns can diverge significantly from what investors might expect. TMF achieves its leverage using a combination of swaps and futures contracts, not by physically holding long-term Treasury bonds. This structure allows the fund to efficiently deliver 3x exposure, but it also introduces complexity, counterparty risk, and sensitivity to volatility. Because TMF focuses on treasuries with over 20 years to maturity, it is extremely sensitive to interest rate changes. When long-term interest rates fall, TMF can surge sharply. When rates rise, losses can compound very quickly. This makes TMF appealing for short-term tactical positioning. For example, when investors expect falling yields, recession risk, or a flight to safety. Some traders also use TMF as a hedge against equity market drawdowns, since long-duration treasuries often rally during periods of financial stress. However, the risks are substantial. The daily reset mechanism means compounding works against you in volatile or sideways markets. Even if long-term treasury prices end up flat over time, TMF can still lose value due to volatility drag. That's why TMF is not a buy-and-hold ETF. Holding it for weeks or months without active management can produce outcomes very different from the simple 3x Treasury returns idea many investors assume. It's also worth noting that prior to May 2, 2016, TMF tracked a different Treasury index. The change had minimal impact on investor exposure, but it reinforces an important point. This fund is designed for precision trading, not passive investing. The bottom line is this. TMF is a powerful but dangerous instrument. It can be highly effective for experienced traders with a clear, short-term view on interest rates or risk sentiment. But for long-term investors, retirees, or anyone seeking stability, TMF is the wrong tool for the job. If you want long-term treasury exposure, unleveraged ETFs are far more appropriate. TMF belongs in the toolbox of disciplined, active traders who understand leverage, compounding, and timing. If this breakdown helped, subscribe to the ETF Investor, and let me know in the comments whether you've ever used leveraged bond ETFs or stay far away from them altogether.